Good morning, traders. Today is the 28th of January, Saturday. As I go through these videos for all of you today, I want you to be aware of the fact that we are setting up in a apexing formation. You can see here these yellow lines right to here, apexing near this support channel, and these charts should be fairly familiar to you. I draw, quite a bit of lines that help me understand what's going on. The real reality, as I did in the last video, is we must break above 410 in order to establish a confirmed bullish trend based on my analysis. We are still in a very consolidated sideways channel. I believe price is going to stay within this range here, this dashed gold line, in this range here. You can see how I've kind of drawn this out going forward all the way over to here throughout the end of the year. This is the end of the year into 2024. I believe this is our most likely predictable price pattern going forward as long as these support levels hold. Now, during this apex and near this apex, we are very likely going to see some extended volatility. So be aware that we could have reached a peak here if we do not get above this red level here, which is the 410 level, which is actually a little higher. But if we do not get above this high back over here, then we are likely going to stay in a consolidated range over here, possibly doing something like this, which would be a consolidation phase and then up. Okay, so understand that we are in an upward trend. We're in a reflation trend, but we're still in a fairly dangerous mode here. We could see a lot of volatility into the next couple of weeks. We could see a rally up into 410, 411, 412, which would be fantastic. That would give us confirmation of a solid Fibonacci price theory uptrend. But we could also come up to 408, 409, 410 and stall. If we get up above 410 on a high, intraday high, and then roll back lower, that could very easily set up a double top formation based on this bar back here, and that could give us some real concern for another deeper pullback over here. No, we are not out of the woods yet. We still need to be conservative about how we allocate our money, and let's go ahead and take a look at the rotational modeling system and the real estate market as we move forward. So here we go. We are currently in the accumulation phase, stalling, basing, bottoming. You can see over here, we've come off of these extreme lows here. This is the SPY. We've got this nice solid basing, bottoming formation on a monthly basis. We need to see this kind of move higher. I expect this to kind of stay flat downward, which would prompt an upward move, not really collapsing like we did over here, but more like this, kind of just stalling out, which may lead into a momentum rally, but we need some impetus for some sort of a momentum rally in the SPY. Right now, I think we're going to just consolidate into March and April, possibly get above 410, 412, 415, possibly, then stall back out, maybe end up back in the 408, 409, 407 area, and then attempt to move higher on the SPY. It's very important that this continues to stay below this peak blue line level here. You can see the weakness is in an uptrend here, is associated with weakness, weakness here, weakness here, weakness here. And you can see that this actually predates the actual rotation in the market. So you can see we're getting rotation here. This is telling us that we're forming a very solid base, very solid bottom, but I don't think we're going to see any real growth in the market until the second half of 2023. Custom Innovation Index is really based in bottom. This is a big move. Everybody's talking about this week. Tesla and Netflix and others, NVIDIA. You know, you've seen a big move. And again, if you were following my research over the last 2.5 months, you were already prepared to take advantage of this move. And hopefully you guys really had some really good success with this, because this was a huge reflation trade. We could still see this come back up to this 85, 88, 89, 90 area back up over here. But I believe we're going to see this stall back out. This is a bubble, guys. Understand that this is a bubble phase. Historically, getting up into these upper channels has been really extreme trending. We could see a bubble phase, a speculative phase, push it back up into this 85-90 area. But understand that would be very, very dangerous. Could be a great move. Don't take it the wrong way. It could be a fantastic move for those that are in. But just trail your stops, guys. This is getting, I don't want to say bubbly, but looks like someone turned up the heat. This is a solid reflation trade. But again, this 85-90 area will probably become serious resistance if we get that high. If we don't get that high, then we could end up stalling back out, staying in an uptrend through the rest of the next 3, 4, 5 months. But this is really looking like it's a bit overdone, in my opinion. Could still continue higher, but again, be aware, this looks really frothy. Okay, the fear index is dropping lower, which is what we wanted to see, 5.56. It moved from 6.05 to 5.56, which is great. Lower fear means we're going to start to see some engagement, some extended engagement, as long as we stay away from this fear factor. This is the SPY again, moving higher, and this is the sentiment index, basing and consolidating near this middle channel. This is very good. Look at this over here after COVID. We had it basing and bottoming throughout this consolidation channel, and you can see how much the SPY actually rallied through this phase. It wasn't until we got over here that we started seeing some real extended trending up into this upside. So right now we're kind of like right over in this area. Very solid look for a move to the upside, but I do expect some sort of a pullback. Once we get up into this middle channel here, understand we could extend a little higher, but there is going to be a pullback. And we need to actually get confirmation of that 410 level on the SPY. We're at 405.86 right now. We got to get above this high, guys. This is a unique high level right here. We need to get above this high, and if we don't, then we are still in a bearish trend, and everything will revert back to the downside. So stay moderately cautious. The custom index valuation trend shows us the same thing, although this tells us that that unique high is way up here. So understand that, you know, we've got a lot further to go here to get up above this high based on Fibonacci price theory in order to confirm an upward trend. We are basing, we are consolidating. This looks good for a potential bottom. Still looks very good that we could see some sort of an upward trend, but we have not come close to moving into any confirmed upward trend yet. We're looking better than we were back in December, but we have not yet moved into confirmed trending. Next, the rotational modeling system has not changed. In a 2-account mode, which is how I run it, I've got 25% long, 75% short. The long position is up 27%. The short position is off minus 1.44. Remember, the long position's been in place since 6/10/2020. The short position's been in place since August 31st, 2022. So the way this works is by having these offset 2 accounts, we actually have 50% of our capital is being offset, to zero. So we have a 25% position long, a 75% position short. This nets us into one account as 50% short, 50% cash. Net result is we are short from August 31st, 2022 with a minus 1.44% total. This is long term. This is really what you want to use to manage your investment portfolio and your 401k, your retirement account. This is really important to understand that this is historically going to keep you on the right side of trend. And like I said, you have 2 ways of operating it. You can run it with 2 accounts like I do, or run it with 1 account consolidated. When we are in this position, SPY, hypothetically 1 account. So we want to be short the SPY or find something that indicates a short position, a downward trending. If you're having trouble finding something like that, then you want to try to find something, talk to your broker, find out if there's some sort of a SPY or a high beta correlation to the SPY that can get you short. When you're in a cash position here, this means either not invested at all, sitting in actual cash, or something that's tied to the US dollar, or something that's tied to a very low risk fund, possibly government bonds, possibly something more diversified, slow growth, very low risk, more so tied to the US dollar. So ideally what happens here is it's either long or short. And again, because of this is, again, 25% long, 75% short, means I'm always invested in this type of scenario. Even though that 50% nets out as a flat position, which hypothetically is cash, in reality, that's what we have here, a 2-account mode or a single account mode. Next, this would be your trading account. Now, let me explain that to you. So we have this first one, which is the rotational modeling system. This is your investment account, your IRA, your 401k, your retirement account. This is how you want to protect your capital based on longer-term trending. So this would hypothetically be 90% of your total capital assets. If you had $1 million saved up in your retirement account, you would be running $900,000 with this type of a setup. You would then hypothetically have $100,000 set up in what I call a trading account, which allows you to trade the markets, you know, daily, weekly swing trading. And that's the basis of my research. So you have the retirement account, and you have your trading account, and this is the basis for your trading account. In your trading account, we would be 20% stocks, meaning you can trade 20% of it, 55% of it would be set to cash, 25% of it set into metals as a hedge position. Alternately, if you can't hold metals in your trading account, which you should be able to do, you would be 20% stocks, 80% cash, 0% bonds. These are the rotational modeling system triggers for the SPY, daily, weekly, transportation, daily, weekly, mid-cap, ES, NQ, YM, gold, silver, crude, bonds, and consumer staples. We monitor these as trends change to look for confirmation. Right now, we're getting pretty good confirmation that hedging and fear are elevated. The mid-cap is bullish, the Dow Jones is bullish, consumer staples are bullish, but we do not have any confirmation yet with regards to the SPY, the transportation index, the ES, or the NASDAQ. All of those are still holding mixed or bearish results, which means that we do not have confirmation one way or the other. We're staying in a hedged position, trying to protect capital, waiting for some confirmed trend right now. This is the historical results of the MENT Rotational Modeling System. You can see here, folks, this is as of December 31st, getting ready to update it for the end of the month here, next week. We had just moved very close to new all-time highs. Let me zoom in here. Very close to new all-time highs as of the end of December. Doesn't look like we're going to get any new all-time highs in January. We'll see how it plays out. But ladies and gentlemen, compared to the SPY, you can see this downturn here. We took a little bit of heat, but then recovered very nicely at the end. That was the end of the year selling. Now that we're back to the upside again, folks, it's going to probably be midpoint down here a little bit. But long and short of it, we're holding up very well. You can see the historical results here for 2022 was minus 0.60%. Very solid compared to some of these other numbers. And this excludes the trading that you would be doing in your trading account. This is just the rotational modeling system for your retirement investment account. Next, the real estate update. Okay, Realtor.com, the individual that did this data must have been on vacation because we went from January, November, and we all of a sudden had 3 weeks worth of data dumped on us. But it's kind of cool to see this big, broad change. So price reductions shot up to 1.6. So 160% of homes on the market are being reduced right now. Think about that. Pretty much everything on the market and anything coming on the market is being reduced right now. Days on market is at a new all-time high. That's actually median days on market here. Active listing count is at new all-time highs. Prices are decreasing and price reduction share is increasing. Dynamic price trend modeling system is showing that model market demand is increasing slightly. We've gone from minus 40% down here in the orange line to minus 15.78. It's a weekly change of 5.227 to the upside. And price factor has increased a bit here. We were at minus 50% back over here, or minus 49. We're now at minus 36. So we're seeing some pricing support indicated here. Now, this is a dynamic quantitative modeling system. What happens is this measures activity to measure demand on the market and price stability or price factor. So we're climbing higher, but still negative. Think about that. We're coming a little bit, let's say we're seeing strength, a little bit of strength, but in a weakening overall market. Okay. Okay, now next. The U.S. price trends are flat. This indicates that the price trend in the market has not really moved broadly away from the zero line. You can see U.S. real estate price reduction activity has shot up. And again, you can see reduction activity is staying positive. This is now about 40%. The orange line is above 100%. So we're seeing a share of market. Everything's being reduced. Real estate active listings change. You can see it's now rolled back to the downside. And you can see the volatility here. So from March 2020 all the way through, prior to this, you can see we had some really solid trends. I'm under the belief, ladies and gentlemen, that this is going to move downward with the Fed. I think the strong GDP and jobs numbers and everything is going to prompt the Fed to maybe stay a bit more aggressive. So maybe another 25 or 50 basis point rate increase. I'm leaning towards a 25% rate increase or 25 basis point rate increase for the next couple rate increases, just to keep that pressure on the market. And I think that's going to send the U.S. housing market into a declining price function. New listing count metrics. So new listing counts are up 16. It's at 69%. That is the, I got to do the math here, is the blue line up here. So we're seeing a huge increase. We've seen more new listings in real estate than we have at any time over the past basically 4 or 5 years. New listing count change is up 1.21%, and a new listing share of market is up 0.01%. So you're seeing a lot of homes coming onto the market, folks. A lot of people are actively out there trying to sell their properties. And as we get large supply, low demand, increasing cost factors, what ends up happening is we start to see pricing functions really start to decrease, which is why we're seeing these numbers really start to increase. Eventually, we will see this number really start to drop. It'll move, incrementally and then possibly into a moderate parabolic type of move. But I do expect this to be minus 10, minus 15% by March or April. Okay, U.S. heat rank. Okay, heat rank is showing a little bit of an uptick here, but remember, this is in negative territory. So uptick in a downward market, could see that we see some upward trending, but I think the Fed's gonna still have to make moves to fight inflation. But again, it's weakened considerably. So this was 2021. This was June 2021. Big shift in direction as the Fed started raising interest rates, pulled back out of it. Buyers continued to play into the market. We've seen a little bit of a tick here in the summer months. And now we've gotten into this weaker market for the heat rank. I think the heat rank continues to just migrate downward. Maybe not aggressively at first, but I think it's going to continue to migrate downward until there's some catalyst shifting the market dynamics. So market tightness index, this is a great little, these two, inventory strength. So So tightness means market's getting tight. That means that buyers are jumping in. And that will align with, so September, November 2021, we come back up here, September through November 2021, the heat rank up here, this was this area. Buyers coming in trying to buy into the market with low inventory. That's what prompted this move here. Then we come back over here, July, so let's measure July 2020 through, so July, August, September, June, July, right over here. Heat rank, buyers started coming in. That's what the heat rank measured here. And of course, the tightness indicated it got tighter in this area. That was this move here. So the tightness is really shot up here. That means that buyers are coming in, accumulating, taking what they can, and or corporate buyers are coming in, grabbing what they can. Then we had a big shift, a huge, massive shift in November 2022 back over here. And this told us that essentially, all of a sudden, that buying activity vanished. This is more than likely when, the Airbnbers and the Zillow groups and the flippers suddenly realized, yikes, we could be in some trouble here. And then we had a bit of a recovery, and now we're weakening back to the downside. We're at minus 20%, minus 19%. Inventory strength is now at plus roughly 3, which is, it means it's holding up. That's indicating we're getting some moderate strength in the inventory strength right now, meaning prices, homes are still moving. They're selling, don't take it the wrong way, and prices are holding up much better than I thought right now. But seller desperation here, seller desperation had gotten a little higher. So this is weaker seller desperation. This is weaker seller desperation. You can see here that we are at minus 115 for seller desperation. So again, people are still holding on to the concept that buyers will come in and buy their house at the highest price that they can get. And we are not seeing that real increase in seller desperation. I would expect that we would start to see some seller desperation really kicking into gear here. So you see here June, July of 2022, that's this area here, June, July of 2022. So you can see here we started getting a little desperation right over in here. Then we had an uptick in inventory strength, and then desperation waned. Then we got a little bit more desperate back over here, which is September, October, November. That's inventory strength weakened. That's desperation increased. And now we've had this strength back up over here in the positive side. That's indicating this weaker desperation here. So again, given what the Fed does, given what happens in the market, and really what happens going forward with the Fed and our government, which is, paralyzed as usual, we'll see how this actually plays out. I interpret the data as, if you follow these, ladies and gentlemen, you can see the downward trend in tightness. You can see the downward trend in inventory strength. You can see essentially the blip, the COVID blip, the flattening, the disruption that took place here, and we've moved kind of into this downward trend. I think that's really the key here, is that price reductions have now moved to the highest level ever. Real estate active listing counts are all over the place. I believe a wave of foreclosures could be coming by the end of next year. And then you really have to understand this new listing count. When inventory starts stacking up, you know the rule of supply and demand, right? When demand is high and inventory is low, price goes up. When demand is low and inventory is high and nobody's really buying, then price goes down. And that's where we are seeing here. Inventory is high, demand is weakening, and prices are starting to skyrocket. And you see that here. So here's our dynamic. Demand is weak. Demand is at minus 15%, has been at minus 50%. I would expect this to roll over as we get into a deeper weakening demand cycle, and that would prompt prices to fall into the negative territory, which is coming. I believe it's coming for price reduction. It's just a matter of time, if this keeps up, that prices will turn negative quarter over quarter and year over year. Okay, that's the update for now. Remember, go to ment.com, check out what I'm doing. All of this content is designed to help you protect and manage and grow your wealth. I do this every week for you. It takes many hours to create this and to deliver it for you. I'd appreciate if you come and take a look at my Expert Growth membership subscription. I just created that beginning of this year. It gives you everything under a single source location, whether you're a real estate investor, any type of investor, short term, intermediate term, long term, day trading. I mean, all of the information is here for you. I do this to try to help you, to try to teach you, and to try to make you a better, more consistent trader. So visit ment.com, see what I offer, support my research by joining the Expert Growth membership. By probably the middle of February, I am going to stop delivering these free updates to everyone, and it's only going to be available through the Expert Growth membership, which includes everything. So come and get it so you can keep getting this data if you want it, and get ready. Like I've been telling you, the next 3 to 5 years are going to be absolutely incredible for traders. We're just getting started on all of this. All right, guys, have a good weekend.